Okay, so today we are looking at a case study that honestly sounds like an absolute fever dream, but I promise you it is very real. We're talking about a singular inflection point in the history of capital markets. This is that unprecedented moment where the sheer, wild, speculative energy of internet culture is actively trying to forcibly integrate with the hardcore foundational cash flows of a literal e-commerce pioneer. It's a complete collision of meme liquidity and traditional corporate finance. The implications here are absolutely staggering. So the big question we're asking is, can internet hype actually go out and buy a foundational tech giant?
Okay, let's dive right into this. The central mystery we're unpacking today is the sheer audacity of Ryan Cohen and GameStop attempting to buy out eBay. Like, is this a genius, venture capital-style play to build a legitimate, heavy-hitting competitor to Amazon? Or are we just looking at the most expensive Hail Mary pass ever attempted in retail history? You have to remember, Ryan Cohen already built Chewy from the ground up to successfully take on Amazon in the pet space. And now, he's trying to do it again, but on a much wilder, completely unprecedented scale. And the answer to whether he can actually pull this off, well, it lies in the data, the balance sheets, and a really deep dive into modern corporate treasury management.
$56 billion. Just take a second to really absorb the staggering scale of that number. To put it into perspective, $56 billion is roughly the entire gross domestic product of a small country. On May 3, 2026, GameStop announced this unsolicited 50-50 cash and stock bid to acquire eBay for exactly that amount, offering $125 per share. That represents a massive 46% premium over eBay's price just a few months prior. This isn't just a merger, it is an incredibly aggressive pursuit of scale, and it completely shifts the paradigm of what we think a meme stock is actually capable of attempting.
Section 1. The crime scene. A $12 billion retailer swallowing a $46 billion giant.
To really understand how wild this proposal is, we need to do a bit of a forensic analysis here. Just look at the absolute absurdity of this setup on paper. On one side, we've got GameStop, a physical retailer literally selling physical video game discs in dying shopping malls. It's a business model that has faced consecutive years of revenue decline. Right now, they're sitting at a $12 billion valuation. And on the other side, we have eBay, a sprawling global digital infrastructure, an absolute e-commerce pioneer with a $46 billion valuation, generating robust operating income and servicing over 135 million active buyers worldwide. It is a reverse takeover attempt where the absolute minnow is trying to eat the whale.
Section 2. The weapon. Weaponizing meme liquidity.
So, you're probably wondering, how does a $12 billion company with shrinking revenues even get a seat at the table to make a $56 billion bid? Well, the answer is they've weaponized something completely brand new to corporate finance: meme liquidity. Think about traditional capital for a second. It's like earning a paycheck through hard work. A company makes a profit, it saves money, it slowly builds value over time. Meme liquidity, on the other hand, it's like finding out some dusty vintage toy you own is suddenly worth millions because of a viral internet trend, and you instantly cash it in. It's capital raised through speculative equity surges driven entirely by retail investor emotion. GameStop has brilliantly leveraged these periodic massive surges in its stock valuation to issue new shares and build an enormous treasury, and it is completely separate from its fundamental retail operations.
Now, what's really interesting about this is how they actually pulled it off. Look closely at this timeline between May and September of 2024. During these months, GameStop executed what are known as at-the-market or ATM equity offerings. Basically, an ATM offering means GameStop was selling brand new shares directly right into the open market while their stock price was being artificially skyrocketed by retail hype. They capitalized on that hype perfectly, essentially printing billions of dollars out of thin air by turning their volatile stock price into a massive financing tool. They pulled in over $7.6 billion in financing inflows in just a few short months. They completely transformed their balance sheet while their actual retail business was quietly shrinking in the background.
It's honestly kind of incredible when you stop and think about it. That incredibly strategic treasury-first approach culminated in a massive cash reserve. As of early 2026, GameStop is just sitting on $9.4 billion in cold, hard cash. $9.4 billion! And this war chest was generated almost entirely from those meme-driven capital market activities, not by selling video games. But listen, this cash is very, very real, and it acts as the primary collateral backing their incredibly ambitious M&A dreams.
Section 3. The motive, venture capital logic, and the Amazon challenger. Let's shift over to the motive and see how this actually builds into a cohesive strategy. Because Ryan Cohen isn't running GameStop like a traditional retailer anymore. He's basically applying pure venture capital logic here. He views this newly capitalized GameStop as an investment vehicle. Cohen is operating on what he calls the Berkshire Hathaway paradigm, but on a much, much faster clock. If you look back at history, Berkshire Hathaway actually started out as a failing textile mill. Warren Buffett used the remaining capital from that dying business to go out and buy powerful, highly profitable insurance companies that generated massive cash flow. Cohen wants GameStop to be that textile mill, and eBay to be the cash cow insurance company. eBay generates $2.3 billion in annual operating income. Cohen is basically trying to buy the fundamental earnings power that GameStop organically lacks.
Okay, but let's look at the actual operational logic here, because it's fascinating. Let's do a step-by-step breakdown of what we call the synergy math. Step 1, micro-fulfillment. GameStop wants to take its 1,600 physical US stores and use them as local distribution centers, bringing eBay's vast inventory way closer to buyers for same-day delivery. Step 2, reverse logistics. Those exact same stores would handle returns locally, consolidating them to cut out massive, expensive shipping costs. And step 3, and honestly, this is the most crucial piece, in-person authentication. The high-margin collectibles market, rare sneakers, trading cards, luxury watches, it's absolutely plagued by fakes. Trust is everything. GameStop staff already grade trading cards and hardware. If GameStop stores become the physical trust layer for eBay, they instantly create a massive defensive moat that Amazon, with its purely digital commodity marketplace, simply cannot replicate.
By executing this physical integration, GameStop projects a massive $2 billion in annualized cost reductions for the combined company within the very first 12 months. They're planning to slash eBay's sales and marketing by $1.2 billion, cut $300 million from R&D, and save $500 million just by consolidating redundant corporate functions. If this actually works, internal models suggest eBay's diluted GAAP earnings could jump from $4.26 to $7.79 per share in year one. Put simply, by merging and cutting all these duplicate costs, they believe the actual profit generated for every single share of the company will nearly double in just 1 year. I mean, it sounds absolutely brilliant on paper.
Section 4. The forensic evidence, technical valuation, and sector multiples.
But right here is where we hit the forensic evidence. We've got to step away from the meme stock hype for a second and look at the hard, technical valuation math that is standing firmly in the way of this narrative. Let's talk about enterprise value to EBITDA multiples. Now, I know that sounds like jargon, but basically, EBITDA multiples just tell us how expensive a company is compared to the actual cash it brings in. A lower number means you're finding a bargain. Right now, the consumer discretionary sector median is sitting around 10.3x. But by early 2026, eBay is trading at an EBITDA multiple of 17.8x. And if you compare that to Amazon, Amazon is sitting right at 18.6x.
So, the fundamental problem here is that GameStop isn't buying some cheap fixer-upper. They are paying absolute top dollar. We're talking tech giant prices for a legacy marketplace. The market is already pricing eBay like a top-tier tech giant. And because of this incredibly high entry multiple, GameStop's synergy math faces a massive uphill battle. Think about it. Even if they miraculously save that $2 billion in operating costs, they are still paying top-of-the-market premium prices just to acquire those initial earnings.
Section 5. The verdict. The brutal truth of the balance sheet.
Now, when you strip away all the emotional retail sentiment and all the online hype, we are left with the unforgiving laws of corporate valuation. GameStop is trying to buy a company roughly 4 times its size. And here's the one chart that shows why the math simply doesn't add up. To fund this $56 billion acquisition, GameStop would have to deploy its entire $9.4 billion in cash on hand. Every cent. Sure, they have a highly confident letter from TD Securities for $20 billion in debt, but you have to know, a highly confident letter is essentially just a fancy IOU from a bank saying, hey, we think we can probably raise this debt for you. It is not guaranteed cash. And even with all their cash and that incredibly risky massive debt load, they still face a glaring $28 billion funding gap.
So the crucial point is this. The absolute only way to bridge that $28 billion gap is through what we call the dilution trap. Think of the company like a pizza. To raise $28 billion, GameStop literally has to bake billions of new slices of stock and sell them on the open market. The slice you currently own as a retail investor, it just became drastically smaller. This move would heavily dilute existing GameStop shareholders. And the real irony here? To buy out eBay, the sheer volume of new stock required would effectively hand majority control of the new, combined entity right over to eBay's current institutional investors. And let's not forget the historic execution risks we're talking about here. This new combined entity would be stepping into a vicious competitive arena. Amazon holds roughly a 40% market share in commodities. eBay has around 3.5%, relying heavily on collectibles and consumer-to-consumer sales. Plus, eBay just bought the fashion app Depop for $1.2 billion, which means GameStop would automatically inherit looming antitrust scrutiny over social commerce concentration. And they have to deal with all of this while trying to merge two vastly different corporate cultures. Merging a physical retail gaming workforce with a Silicon Valley tech workforce that is notoriously difficult and presents an astronomical execution risk.
When we step back and look at the whole picture, we're really left with two totally conflicting realities. On one side, we have the narrative, this grand vision of a $100 billion Amazon rival, fueled by the brilliant utilization of retail sentiment and venture capital logic, creating this powerful physical and digital hybrid. But on the other side, we have the balance sheet, the brutal, unforgiving reality of massive shareholder dilution, potentially unsustainable debt loads, and historically unprecedented execution risks.
We know for a fact that meme liquidity can print billions in cash out of thin air. We've seen it happen. But when the internet hype inevitably fades and the hard, cold math takes over, can meme equity truly buy fundamental reality? That is the billion-dollar question. It's a question that is undoubtedly going to define the future of capital markets in this new finfluencer era. Thanks so much for exploring this with me.